Well, here we are, folks. Another Tuesday evening. Great to see you all on, and thanks very much for spending some time with us. Very interesting conversation this evening with Damien Klassen. I'll bring him in just a second. We're going to cover AI, the RBA decision today, some of the broader dynamics. We might look at China a little bit, and also some of the other very significant issues. For example, what's happening to prices and how come prices and food prices are perhaps moving in different directions. So we'll talk about that as well, perhaps. And of course, there's always time for you to ask questions. If you'd like to put them in the chat, use that Walk the World to get my attention. That makes sure I see them. We're not giving specific financial advice. It's just a general conversation. And, if you need specific financial advice, go to a financial advisor. But this is a general chat tonight. We do have Super Chat enabled, and you can get your question top of the list using Super Chat, or indeed, if you'd like to make a contribution to what we do here, it's always greatly appreciated. Anyway, let me bring Damien in and get him to unmute first. And Damien, how are you doing?
Very well, Martin. Very well. How are you?
Yeah, I'm pretty good. There's a lot going on, isn't there?
There is plenty going on. Yes. And one of the big one. As you said, I think there's a whole bunch of ones. I wouldn't mind spending a bit of time on the AI side, if I can, because I think it's important for people to understand what's going on in that sector. I think from a big picture perspective, because there are lots of things, and the stocks within that are really affecting markets. Over the last month, we've seen this, relatively good stock market from a big picture sense. But actually, if you look at what's called an equal weighted market, things don't look as good. So it's basically a couple of big stocks really driving this whole rally. And so really understanding what those stocks are doing and where it's coming from, I think, is important for anyone who's thinking about playing in this space.
Yeah, I think you make a really interesting point. If you look at the US markets in recent times, particularly the tech index, they're up. But it's a very, very narrow basis, isn't it? And that suggests also that other sectors of the market may be going in rather a different direction, and perhaps the true momentum is being supported by AI and what's going on there. But it's pretty narrow based. And of course, there's a question as to where they're going to make money from, what's the future look like, and is this another, tech wreck forming, or is it something else? And I guess it may be too early to know for sure, but it's a certainly interesting conversation.
Yeah, that's right. And if it's a tech wreck forming, that's there's some people who want to play in that, and at least if you know that, you play in it if you like, but as long as you understand where the risks are and knowing what's knowing that you're doing this in full knowledge rather than just like a naive belief that, hey, this is the new latest and greatest things and it's always going to go up. And I guess from that perspective, you want to be aware of what's going on.
And is it too stupid to say there's a lot of hot money still sloshing around the system and it's looking for the next latest greatest home? And
oh, absolutely.
We went into crypto at one stage, and then we went here, and then we went there. So, is this another example of hot money finding?
Yeah, and the robots. They talk about this. There's an AI boom going on, obviously, in terms of a number of stocks. But there's also this overlaying thing: is that if you look through who really owns the market at the moment, who's long and who's short in terms of versus traditional positions, it tends to be fund managers who are fundamentally based, that have been underweight or the last little bit on the basis that actually earnings don't look that good and the markets are expensive and all these things. Whereas the robots, the sort of algorithmic traders who are basically, if things are going up, you buy them, and when things are going down, you sell them. They're the ones who have been sort of net long into this market, and that sort of says one of two things. It says, okay, if you get a reversal, so if things start to fall, they could fall really quickly, because once the robots decide to sell, that's not a slow process. They don't, they don't sort of suddenly decide they don't sort of gradually decide over time. What'll happen is they all trade off similar things. They start hitting similar levels, and then the market just takes a big dive down. The flip side is if they happen to be right, or we get a whole bunch of earnings turn positive, and all these people who think recessions are coming and higher interest rates are going to cause problems, if they're all wrong, then actually the all the fundamental people needing to buy in, that's the fuel that will sort of push the market higher. And that will tend to happen over a longer period, though, because sort of one by one, people will finally go, actually, you know what? Maybe I was wrong. Everything is going to be all right. It's going to be, earnings aren't going to fall. Markets can handle lower interest rates. Bankruptcies aren't going to get to us. So, go out and buy the market. And so, that's your sort of two scenarios to your bullish and your bearish side.
Yes, and nobody quite knows who's right? It's because it's a combination of multiple cross currents. So how do you want to play this? Do you want to do the AI bit first, or should we just cover the broader market first?
Let's talk AI first, because I think there's because I think that might colour some of the later discussion. Okay. So the key one to note is NVIDIA. So what sort of sparked most of this was NVIDIA coming out and saying it's got NVIDIA does a lot of stuff, and I'll move into what NVIDIA does in a minute. But it's got this data center division, and it's basically come out and said, hey, over the next 90 days, we're going to double our revenue in this data center division, and that's their biggest division. And so it's going to add about 4.5, maybe not quite 4.5, about 4.3 billion extra in revenue. Sorry, that's going to come through, and most of that's going to flow through the bottom line as profit. So you're looking at this company and saying, and this company was trading, and so that's 4 billion in a quarter. So you can sort of extrapolate that out, 4 and a bit billion in a quarter. So you can extrapolate that out and go, okay, maybe it might be close to 20 billion over a year. And so the share price went up by about 300 or 400 billion in terms of the total market cap, and that put it up to about $1 trillion, which is sort of a bit of a magical number. There's not many companies at that size, and it puts them up in the top sort of 10 companies in the world in terms of the size. And that was what sort of caught a lot of the attention of people, because while it's expensive, it's not so expensive that if they could do this again, like if they can double their revenues in one quarter, and then they can do it again another time or two, then all of a sudden the stock is relatively cheap. And so the real question is coming back to is that possible, and how big is this market, and what does it actually mean? So NVIDIA itself. And the other thing with NVIDIA is it's this name that people don't really know what they are. Whereas I think for Amazon and Google and Apple and all these other $1 trillion companies out there, people understand and use their products and know what they are. Whereas NVIDIA, is dominant in this sort of graphics chips for computers. But that's just not that big. Like there's, yes, it's a great. They do have a dominant market share within these dedicated graphics units, but sort of 85% market share within that. But depends. Then that's quite a niche market. And if you take it one step further and say, well, what about all graphics units? So both integrated graphic units and dedicated, then they fall to like second or third. Like you get Intel and AMD sort of suddenly jump in front of them. And their market shares, more like 10 or 15%. So massively dominant in this tiny little area. They also had this real interesting crypto part to them. So, over the last couple of years, NVIDIA's share price already spiked to almost $1 trillion on the back of this massive growth in terms of their sales. Their gaming division sort of went from $1.5 billion a quarter of sales right up to almost $4 billion worth of sales. And the reason why was because the NVIDIA chips were really efficient at doing Ethereum, which is a cryptocurrency for anyone sort of not in the know, sort of the second largest cryptocurrency behind Bitcoin. So and people were using NVIDIA chips to mine this, and you didn't really know which ones were being, how much of their gaming revenue was real people buying gaming chips and how much of it was for mining. And then what happened was Ethereum went from what's called proof of work, which is go out and do all these complicated calculations for us, to proof of stake. So that dropped the amount of calculations needed by like more than 99% fall in the amount of sort of energy needed by Ethereum. And lo and behold, NVIDIA's revenue in that division, in their notionally what they call their gaming division, also dropped by like $2 billion per quarter. And so it had this, the price ran up to almost $1 trillion and then tanked, sort of dropped in half. And now we've had this next jump where now it's being very much used for they've come out with a bunch of AI products that have sort of caught the attention of everyone, and they are very dominant in this AI space. So they do produce this whole ecosystem of which I'll get into in a minute. If for anyone who's sort of interested in where can you make money in the AI sort of space, but it's this sort of it's this real interesting story about, okay, how much value is in this stock? How good is it? There's this moving parts about they don't do Bitcoin mining really. Bitcoin mining is mostly done on a different type of chip, but they did do Ethereum and a whole bunch of other cryptocurrencies that are a lot smaller. So how much crypto money is still sort of embedded in their price that could fall out. They've also been banned from China. So the second largest market for artificial intelligence is China. And the US has banned the high-end NVIDIA chips from China. And so what that means is China is out there busily trying to create competitors to NVIDIA. So, you've got this sort of used to be their biggest or second biggest customer, and now it's about to be potentially or quite probably a competitor of some sort. When you look at a company and you say, actually, isn't this weird that they can double their revenue in one quarter? Like, we've got all these supply chain constraints, and we know these factories, like chip factories, the car companies just spent the last 2 or 3 years complaining they can't get chips. So how did NVIDIA manage to turn around and in 90 days literally double its production? And you go, well, that's because they don't produce themselves. They actually outsource their production to Taiwanese semiconductors and all these other contract manufacturers. Global Foundries does a little bit. They've got some other ones that do most, but most of it's these outsourced what's called foundries that do all this for them. And so what that's sort of saying in a way as well, if you're talking about sort of the Warren Buffett economic moat, is you're like, okay, NVIDIA's got these great chips, it's got this great ecosystem for doing this AI, but they don't actually have this, like, it's not like they have this special technology of producing these chips. That's done by somebody else. And so if somebody, an Apple or a Google or AMD or one of these other people come up with a great chip design, they could get the same capacity and scale it up and have it done really, really quickly. So in terms of economic moat, NVIDIA is in this great position, but it's not as safe and secure as what you might think. And so, and then you go, well, AI is this great space to be in, but and NVIDIA's got this massive market share. It's probably 80-90% of the market of this of all these data centers. But when you look at the competitors, Google's got a chip, Amazon's got a chip, Apple's got a chip out there, AMD's got a bit of a foothold. Intel, it's not really in this. Well, Intel's trying, but they're not really on the board. But they do have. They are the biggest seller of graphics processor units, which are very similar calculations, and they've got this massive. They've got one of the largest research and development budgets in the space. Microsoft is sort of involved in this space, but they're probably more of a customer than anything. But when you look at the competitors, you're like, well, they're basically all the biggest companies in the world that are all trying to get into their space. So yes, they've got the massive market share. You want to be NVIDIA rather than anyone else, but it's not like they're in an impregnable position and with only a few sort of smaller competitors. They do have some of the biggest and companies with the biggest R&D budget sort of chasing them. And then you get to this, data centers.
Damien, a quick question there. How much of this is a US-centric thing? Because you mentioned China and what have you. I'm not clear as to whether really it's a global phenomenon or whether it really is just a few US companies who are actually driving the agenda with NVIDIA at the top of the curve, as it were.
It's global. It's definitely global. The US companies are in the best position for it, is probably the best way to say it. But having said that, there are, Taiwanese Semiconductor, or TSMC, is the world's biggest producer of all these things, and so they're largely Taiwan, opening up some stuff in Europe and the US as well. If you go one step further back up the chain, you get in terms of who's producing the machines that make the machines. ASML is a big Dutch company that's sort of very much front and center in terms of these. And the use of AI is very much a global phenomenon, I guess, in terms of companies. I think there's many European companies trying to get into the how can they use it as US, but yeah, US certainly dominates it in terms of chips and software at the moment.
And the reason I asked that question was because, of course, AI, particularly the generative AI, is using information that's out there, right? And so presumably information in the Western language set, including American and English, has probably as much reach as almost any other. So do they have a natural advantage because of that?
Yes, they do. And that's one of the issues with some of the Chinese ones, which are part of the reason why they think that they're behind a fair way, not only because they don't have the latest technology, but also there is this issue of if you can, and we were talking offline, we're talking a little bit about the browser wars. If you've got two big companies and one's got the greatest system, one's got the system that's 20, 30% better than the other one in terms of this AI, say that's OpenAI, and then you've got Google sort of running second. If OpenAI goes, okay, we're going to start charging for ours, and we're going to have 100 million clients using ours because ours is the best, but Google's giving it away for free and they've got 1 billion clients, then Google over time is going to get better because they're asking more questions and doing more queries and learning more from people that are using the system, who are going, no, that answer is not right, or yes, that answer is right. And so so I do think this is a little bit of a winners takes all market, or at least you'll have a couple of big players, but I don't think you'll have much more beyond that. And I do think that English language is going to dominate, in the sense that, yes, that's where a lot of these big US companies are, but also they're just going to run so many more queries. You've got so much more of the world who speaks English, often as a second language, but they just have the advantage of the language systems are going to have seen so much more English than what they're going to have seen, say, Dutch or French or Cantonese, that they're just going to be better at answering the questions and coming up with the right answers. Yeah. So actually, that's probably a good point to talk about the technology stack. So where can you get into this? So at the sort of I'll start at the bottom. Okay, I'll start. So at the bottom, you've got the actual software that's producing this, and in terms of producing the software, really you've got OpenAI and you've got Google. They're the main players. There's really not many others that are involved. A lot that are trying, but there's not really there's not really many competitors within that. Then you've got the compute part, which is who's actually doing the computation part and how they involved. So the bottom part you sort of call the models, and of this compute part, there's sort of like three different parts of it. You've got the software part, which is how do we get the queries and manage the sort of the libraries and all the sort of the building block software. Then you've got the hardware part, who's doing the hardware and the graphics units and sort of accelerators and these things like that. And then you have the system and networking, which is a lot of this is using so much data and everything like that you actually need some other parts. And so if you look at those sort of three middle areas, NVIDIA's in all of them. And that's where their most dominant position is, because they operate across all three. They've sort of got an integrated solution, and from everyone who's using it, it's the most user friendly, and all the documentation and all that type of stuff. It sort of fits the best. Google is also across all three, so they're sort of playing in that space as well. Second, you'd call them second at the moment. They've probably got some leadership in some areas, but behind in others. And but also, NVIDIA's a lot more open in terms of they're trying to work with others, whereas Google's like, no, we're trying to get everyone into our sort of system. Then you've got OpenAI, which is also sort of playing in this sort of software levels, but none of the other levels, none of the hardware or anything. You've got companies like AMD and Amazon are also trying to play in the hardware. They're sort of bigger ones. Lots of other sort of minor players, but AMD and and Amazon or AWS are playing in that. And then you get back to the system and networking, and again, system and network is largely NVIDIA and Google, but also Broadcom, which is sort of a name a lot of people wouldn't have heard of, but they're very big in this networking side, and in particular, sort of networking some of the systems for the AI. So that's sort of your middle section, and then at your top section, you have all the sort of infrastructure, the cloud computing players who are really benefiting because when you want to run these tests, and especially the ones that want to ingest the internet to run, you need you don't have to own this hardware yourself and then sort of run a test and then not use your hardware for a couple of months while you're doing your next bit and then go out and use it again. So the people that are renting the space, Amazon, Microsoft, and Google are your three big players in that. And so depending upon what part of the market you want to get involved in, that's your sort of bigger players. There's lots of little niche players down below, but that's sort of the overall way to think of this. How do you get exposure to this market?
Yeah, and one of the questions I've got also is, to what extent is the output, consumer, or is the output B2B? And I'm thinking of if you coupled AI with share trading, for example, is that a whole new thing? What are the application sets that flow off the back of this?
Yeah, well, and this is this part about how well NVIDIA is going to do. A lot of it comes down to saying, if you go sort of stock standard server that you might put in on one of these to run AI queries, a sort of more general AI queries, NVIDIA probably makes about 20% of the server. The server might cost 10 grand. NVIDIA might make $2, maybe $3 out of that would go to NVIDIA. Then you get like all the memory guys and the storage and the networking and all these other bits that go into that. So if that's what we end up with, NVIDIA does well, but not like great out of this whole thing. The flip side is if it's actually, and what you'd use those queries for, there was a great example the other day. Goldman Sachs or Morgan Stanley, just applied for a patent on some AI that they've got that looks at Fed statements and tries to work out what the next move is going to be based on AI about reading the Fed statement. And you go, okay, yeah, that's great, but it's not that complicated. It's not that big of a data set. I'm just taking all the Fed statements and all their speeches that they're making and all those things and running it through my machine learning bit and spitting out the other end. I could probably do that on my laptop without too much problems. Like the data set's just not that big, versus saying, feed me the entire internet and then make inferences from it, like AI is, like the OpenAI is doing and ChatGPT. That's complicated, and that needs to run on bigger machines. And so, and even say you're doing biotech and you've got like DNA or something like that, which is, you've got the quite big data sets, or as you said, the stock market, and you've got quite big financial data sets. They're big, but they're not that big. Like they're not, you can run those on sort of more normal servers and not sort of overtax them. Whereas if you said, please go and ingest the entire internet and run these things and spit out the answers, that's where you need the really high-end NVIDIA stuff. And that stuff, they might charge, $300,000 for a server, and NVIDIA probably gets 80% of that money. So if the boom coming up ends up in all these supercomputers because everyone wants to ingest the entire internet themselves and run their own models and create the answers, then NVIDIA is going to be a big winner. If it's an explosion of tools that people are generating, then NVIDIA does well, but nowhere near as well. And that's sort of one of the key measures. And think about it like a regression. Hopefully most people listening, I'm not being too complex by saying, when you want to run a regression, say I'm trying to correlate two variables between each other. And I'm going to get an answer which is going to say, why this variable is equal to 1 plus 1.24 plus 6.5 times whatever my X value is. So that's going to be my formula that I'm going to get out the other end. Now, calculating that formula is intensive in terms of the calculation. So I'm going to run all my data through it and do all my tests and work out confidence intervals and all that type of stuff and come up with those variables. Once I have those variables, though, running the calculation is really easy. If I have an X, I run it through my calculation and I spit out a Y. So, and AI is very similar in that sense, in that you've got this really intense computational phase, and then you have a model. And the model's quite simple in terms of those calculations. And so all this stuff I'm talking about in terms of AI, the calculational part, it's all about how often do people want to run these models, because that's what really takes the cost of money. And so, it's a question about how much are they going to run those, who and which companies can afford it, and because let's say it's a $10 million process, which it'll come down over time, but it's probably $10 million ish to run one of these tests. How many companies genuinely have enough money to say, yeah, I'll run a test through and spend $10 million to ingest the entire internet, and spit out the answers based on my specific models and my specific tests. And then how often do you want to do that per year? Is that something you want to continuously do? You do it once a week or once a month? Or is it something that you're like, no, I'm going to do it once and that's it. I'm going to live with my model for the next year before I need to sort of update it and run these tests. And so, so that really depends upon how big this market's going to get. What's the other one I wanted to talk about? That's right, data centers, because that's what I was. So we're back to NVIDIA's, their biggest customers, these data centers, and saying how much are these guys going to spend. Now, if I'm like if I'm buying an NVIDIA chip and I'm a gamer, so let's say I'm a 20-something man child, and I'm putting together my gaming rig in my parents' basement, and I've got a choice. Do I want to get the latest video card from NVIDIA for $2,000, or I just want to spend $500 on a decent one? And the $2,000 card might be 25% better than the $500 one. So for me, as a gamer, I might go, yeah, sure, I'll spend that extra money. I'm already spending $5,000 on my machine or whatever you're spending. Sure, I'll throw in an extra $1,500 and I'll get the better card, and I can now be better at my games or feel better about myself or whatever it is. So you do have a chance to upsell within the gaming part. Within the data centers, it's not as clear cut, because data centers, are all about distributed computing power. And if it's like saying, well, your card's 25% better but costs 3 times as much, maybe I'll just buy 4 or 5 of these other cards, or I'll buy 3 cards for every one of yours, and I like to have more computing power. It just might take a little bit longer, or needs to be more distributed. But data centers aren't the types of companies you can really screw on your margins. Maybe for the next year or two you might be able to, because of the whole hype. But I think in the longer term, you can't expect to get, massive profits from these data centers.
Yeah, absolutely.
So yes,
and a question I've got, which when you look at this, what you discover is that some of the information that's being produced by the AI processing comes up with mirages and phantom references and things like that, right? So. And it's also quite illogical sometimes. There's one I was reading the other day when they gave an AI the question, is this person alive now? They said, this person was alive this morning at 8 a.m. The person will be alive at 6 p.m. this evening. Is the person alive now? And AI couldn't figure it out.
Yes. Well, and there's a court case at the moment with... for anyone who hasn't seen it, in the US, where a guy had used AI to generate his defense for his client, and the AI came up with all these precedents. And when the other side couldn't find the precedents, they asked for more detail, and he asked ChatGPT for more detail, and it gave more detail. And then they went back, and the precedents didn't exist; it had made it all up. And so. So now the lawyer's being sued the judge's up against him that. So there's definitely problems with it. But it is, but I guess what I'm saying is we're still at the early stages of it. We're 6 months in to this whole thing, really. I guess what I'd say is, I think you really need to think of it as a productivity tool. For the way we're thinking about it is like the creation of the internet or the personal computer. is that in the 60s and 70s, every office had a typing pool and assistants and all that type of stuff, and someone would do stuff. Someone would want to send out an inter-office memo, and they'd tell one of their assistants, type this up and do whatever, and then mail it out to people and go stick it in everyone's pigeonholes. Then the personal computer came around, and you could fire half the desk, because people could do it themselves. And then email came around, and you could fire another half of whoever was left, because now you could email out these things yourself. And then we had the internet and scheduling and all these things like that, and you just got fewer and fewer assistants within these teams. Engineers designing things had to do it all by hand. They needed all these extra assistants to help them. They just didn't need them once you had all the PCs. And I think that's where we're looking at, is that the real boon is going to be in terms of saying, it's making the people making the decisions much more productive. And so for computer programmers, for example, a year ago, you might have had the most senior programmer would sort of write most of the program, and then they'd ship all the little components out to all these other ones and say, okay, you go and do all the security. I've written the functional part of it. You go make sure it's secure. And then somebody else go and do some error trapping for me, and somebody else go and do the documentation and things like that. Whereas ChatGPT can do a lot of that for them now. So they just don't need the assistance. And so that person's more effective. So where does that mean the money ends up? So you look at the sort of, there's 4 tiers. So you go, okay, if everyone's getting more productive, does the money all end up with the AI people? So are they the winners where, I become more effective and I fire somebody that I might have been spending $80,000 on. With this, do I have to then spend that $80,000 on buying the AI stuff? And to me, the answer is, in most sectors, no, that's not going to be the case. Maybe the AI will make a little bit of money, but in most sectors, it's actually going to flow through to others. And then you go, okay, well, is it? There's 3 other places it can end up. One is you can end up in lower prices. And I do think within sectors where you've got lots of competition, that effectively it's going to get all competed away. So if you're a car company, for example, and you don't need as many engineers because you can do designing a bit more efficiently, and now you can produce cars for cheaper, I don't think that's going to end up in higher margin. I think all your other car companies are also doing the same thing. They're all going to chase things down, and you're going to lose. The consumer is going to be the winner in that case, in that prices will be lower. So that's one place, and so sector by sector this will vary. The other place it can end up is in higher margins. So companies can just say, great, I managed to save myself an $80,000 salary. I'm going to pocket that, and that's extra margin that we're going to get. And so high quality companies, I think, will be able to do that. So companies have managed to put through these price rises and can hold on to it, or oligopolies and monopolies and things like that. They're going to be able to do that, especially if they've got lower value employees. And then the third place is maybe it ends up in higher wages. And there will be some companies like, say, lawyers or doctors, where you have models where, yes, my lawyer's just saved the company $80,000, but actually, he's going to give himself a $50,000 or $60,000 pay rise because now he's much more productive and he's generating all this money anyway. And so, so you've got those 4 different areas. The AI, it can go to higher wages, it can go to lower prices, or it can go to bigger profit margin for companies. And everyone's going to be a mix of those. But I do think the key thing for people to be thinking about as you're going, what companies do I want to be investing in that are going to benefit from this? For me, it's very much quality companies. You want to get the companies that can hold on to the price rises. You also want to be looking at companies like, what are some of the other features we want to see within companies is we want companies that can, sorry, let me pull this out. Some of the high service cost businesses, so things like healthcare and things like that. So you're looking at companies where spending a lot of money on services, but there's potential you can really eat into your costs where you haven't been able to before. I think some of the defense contractors are going to be big winners out of this. So, the whole military space is definitely going to eat this up in terms of looking for ways to create, military advantage. and a little bit your interest rate sensitive stocks. So I do think this is a deflationary effect on society. So interest rate sensitive, and the stocks you want to avoid are your value stocks. So stocks that are cheap because they don't really have that much control over their margins. They're the ones that will probably see a lot of the benefits of erode in lower prices. I think where you can see anyone that's an intermediary that's still left. I think the internet really smashed into intermediaries generally. So say your travel agent really got smashed by the introduction of the internet. For any intermediaries that are still left, I think this is going to be another big problem because AI is going to be working busily trying to intermediate them. And then just use sort of broadly competitive industries and disruptable ones. And I've got a whole podcast for anyone who's interested, can jump in. I spend an hour talking about which sectors are good and which ones are bad. But the big picture is, avoid those sort of disruptable ones and try and sort of make sure you're getting into these quality names and the high service cost businesses that you think can hold on to these margins. Yes.
So it's certainly changing the game in so many different ways, although, precisely how it all plays out, who knows. I guess a couple of interesting observations, very energy intensive. So from a carbon footprint perspective, more processing, et cetera, bigger data centers. That's an interesting question.
Quite energy intensive. I would say if you were going to spend $10 million on ingesting this and doing the calculations and all that type of stuff, 5%? Would that be energy? Maybe 5 to 10% of that would be energy, I think. I have to check the numbers on that. I'd guess closer to 5. Yeah, so it's energy intensive, but not really. Well, let's see. This is the interesting question. I give you $1 million, Martin, and I say, you've got this survey. I want you to go away and get it and do some AI on it. Here's this stuff, go away. Where are you going to spend the money? For most people, most of the money is going to get spent on salaries. It's unlikely that you're going to say, okay, I'll just hire, a recent graduate for whatever $80,000, $100,000, and then I'll give them a $900,000 budget to go and spend on computing power, and I hope I get some good answers. Most of the time, you're like, no, I want to spend. I'm going to buy, 3 or 4 different programmers and data scientists and all that type of stuff and spend $150,000 or $200,000 on each. And so I'm spending whatever it is, $800,000 on my $1 million budget on staff. And then, they might go away and do the calculations on that. And if you've got, say, your data set, again, it's a big data set, but it's not that big in terms of, versus the entire internet. And you could probably run it on a laptop, or certainly you could run it on some relatively lower spec machines, at an Amazon or Microsoft. You'd probably struggle to spend $200,000 on processing. So it really, it really depends upon how many people are going to say, no, I actually want to take my data set, integrate it with some sort of large language model, and then spit out an answer at the other end. And how many people are going to go, no, that's fine. I'll happy to use the ChatGPT version of its output, and I'll just I'll do my own AI within my model. So, and that I don't know the answer to which one we're going to end up in. I suspect there'll be more people dealing with sort of pre-built versions, and then there'll be a couple of companies that will go, no, I really want to build my own, ingest the whole internet, spend whatever $10 million now. There'll probably only be $1 million in a year's time, say, to do that type of calculation, and maybe coming down. But yeah. Does that answer the question?
No, I genuinely, I didn't know the answer, but it seemed to me that this processing stuff and the additional stuff is significant. I guess the other point is that AI, of course, can handle not just text, but you can also handle graphics and video, which takes us into the interesting world of, are you watching what somebody actually said, or are you actually watching a construction based on what that person said over a period of time, and then actually processed through an AI engine and into an artificial environment that's actually then created this entity which effectively can say what you ever wanted it to say.
Absolutely.
There are some interesting questions about should you flag it's AI versus not? What legislation needs to be in place? What regulation needs to be in place? And in fact, today in the UK, there was a discussion specifically on the risks of AI and the fact that, people are still saying, well, it can actually take over and do things that you don't want it to do. And of course, there's the famous example of, I think in one AI simulation, when the AI decided that the operator was the problem and got rid of the operator, right?
Yeah. I think there was a military one with that one where they were basically going, you were trying to insert the person to say, the computer would work out, do I need to kill or not? And then the person would make the decision, do I follow, do I stop this process or not? And then the AI basically worked out, hey, there's somebody keeps on stopping me from doing what I want to do. I need to kill that person. It's like the order I need to give. And then I'll be able to do what I really want to be able to do. Yeah. There's absolutely problems in terms of those. And look, already the technology is relatively close that somebody could take, for example, hours of footage of Martin North and work out, create a realistic enough looking model and decide to run the DFA version 2 channel and look at the type of, run your questions through what types of questions might Martin ask and run a separate channel and get me on there to answer questions. And I might not even know that I'm not talking to Martin. So, yeah.
That's all right. I'll go sit at the beach and let somebody else do the work. Yeah. But I mean, it is. Yeah. Think of it in the context of elections, politicians and political influence, and to what extent could people be adversely influenced by stuff that they didn't realise was actually not real? And that, of course, is the risk. The broader context of some of these discussions. I mean, I'm somebody who's quite enthusiastic in the use of technology and can see the upside, but also the downside. And just coming back to the investment perspective, what sort of horizon, if you're making these decisions or thinking about investing in this, what sort of horizon do you think over?
Oh, yeah, look, and the hardest part with this whole market as well is, we need to think about the longer term perspectives of this. So I guess the way I think about this is I have some broader overviews about the productivity side that I'm saying, okay, these I think are going to be the constraining features of the market. Now you've got the very short term thing. What's happening at the short term? And that's the part where it can get very tricky. So let's say NVIDIA is a great example about saying, okay, I'm trying to get a valuation for NVIDIA. How do I do that? Now, they just doubled their profits, doubled their revenues in this division, and it would have more than doubled their profits in that division over the course of 90 days. Like, okay, so what are they going to do over the following 90 days? They're going to double it again? Or are they going to increase it by 50%? Or are they going to introduce, or have they reached the limit? Is that, is it just going to this, is it jumping to this new level and that's what the spend is going to be? And so it's very hard when you've got these massive growth companies to actually try and extrapolate out, because if you make an assumption they're going to double for 3 quarters, that's 3 quarters in a row. That's very different to 1 quarter and then 20% growth after that, or whatever your assumption is. You just end up with wildly different numbers. So it's much better for me to look at the overall market and try and work out what's happening in the overall market. And so if you look at that, for example, data centers spent about $200 billion last year on capital expenditure. And they've been growing that sort of 20% per annum. And so if you said, okay, well, instead of $200 billion, what if they spent $500 billion? What happens if we went into this massive, they doubled plus another 50% in the next little while? How much of that could NVIDIA possibly get? Where does that go? When you sort of work through the numbers and you go, okay, well, so we've gone from 200 billion to 500 billion, say, over a couple of years. So we're adding about 300 billion in sales. Now, traditionally, about 60% of that goes to data centers. So, let's call it 170, 180 billion dollars you're basically adding to data centers, which could potentially end up being spent on NVIDIA. And then you go, okay, well, how much of that then goes to servers? Because as you said, like there's the There's the power, there's networking, there's staff, there's infrastructure, there's rent in this thing, there's fireproofing and all these other things they do. So then you go, well, about 60% again goes to servers. So now you're at like $70 or $80 billion that could be spent on servers. And now you get back to that question I was talking about before about saying, well, is it lots of the lower end servers where NVIDIA gets 20 or 30% of it? And so $80 billion becomes $15 billion, which is roughly what they've already announced as a sales increase. Or is it all going into these supercomputers where NVIDIA gets 80%? And at which point, now they're making $50 or $60 billion. And so, let's say we halve it, we pick it somewhere in the middle, and you're like, okay, that's like a $40, $50 billion increase in their sales. In terms of profits, let's call it a $30 billion increase in profits. Now their market cap just went up by 300 or 400 billion. So, arguably we've already seen that. Like, if you actually sort of added an extra 30 billion to their profit, that would put them on a PE of about 20 times. And 20 times is pretty high for a semiconductor stock. Like, if you sort of said, you look at something like an Intel. So 20 years ago, Intel was, the equivalent of NVIDIA. And Intel spent 20 years, well, of the last 25 years, Intel spent 20 of those years being like the preeminent one out there. And it sort of would tend to trade on 10 to 15 times. And then it's run into a lot of problems in the last couple of years. But, I guess what I'm saying is, they're volatile. These are volatile stocks. Like NVIDIA, even as the preeminent stock, it's doubled and halved its profits maybe 3 or 4 times over the last 20 years. And if you looked at one, say Micron, which is a sort of a similar company, but more volatile in the memory space, and they have, what have we got here? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So they have 11 times they've either doubled or halved their profits in the last 20-something years, 25 years. And you just go, that is extraordinary volatility. And that's the nature of these semiconductor stocks, is they go through these, build big factories, the prices all fall because they're trying to pump as many chips out as they can. Then they get to full capacity of one factory and they start making these massive margins. They start building another factory and then the margins drop again. They go through these phases. And so you just don't want to be paying top dollar for, if you're talking about if NVIDIA is making $40 billion in 10 years time, and they've got like a 90% market share, you just don't want to pay top dollar for that. If it's just growing, then it's sort of like an average rate because, AI is in a steady state. I guess that's where I'm coming to is I liken NVIDIA to Cisco. So Cisco in the tech boom was the equivalent of NVIDIA. Cisco does all the networking to keep all your routers and things like that for the internet. And they're the best out there, and they had the best servers and the best routers and everything like that. And the same thing, you need Cisco to be able to run the internet. They're doing the picks and shovels. And if you look back at their profits have been fantastic over the last 20 years. Like, they were earning 30 cents per share 20 years ago. Now they're earning maybe 40 cents per share. Now they're earning $4. And so it's up 10 times. Like, it's this, you look at the profits and you're just like, yeah, what a fantastic company. And it's pretty much a 45-degree angle, straight line, great profit growth. If you bought Cisco in 2000, you're down about 30% of your money by today. Like, the problem is you just paid too much for it. And a great company, did everything, it's still one of the greatest, one of the best routers out there and quality company, but you can pay too much for a quality company. And, lo and behold, the whole value of the internet didn't accrue to this one company that happens to do routers really well. And I think that's where I look at NVIDIA as the same type of thing. Yes, they're a great company, solid part of AI. You couldn't do AI as well without them. But, if they didn't exist, or if they were priced at 10 times the price of everyone else in terms of the cost, then people just start using AMD chips and Google chips and say, well, yeah, they might only be half as good, but they're a tenth the cost. So, that it actually works out more efficient to just have more of those than using the NVIDIA ones. And so, yeah, I like NVIDIA, great company, love the profit outlook and all that type of stuff. I just don't want to pay top dollar for it. And having said that, though, I wouldn't short it at this point. So could I see that this stock could double or triple again from here because the hype cycle gets going and off it goes? And yeah, sure. I don't want to stand in the way of that one. But from a fundamental perspective, do I think there's value at $1 trillion in market cap? Look, I can see maybe they might make 40 billion if everything goes perfectly right. So that puts them on 20 times. That seems expensive to me. And if it wouldn't take much for me to come up with a $20 billion profit, going forward as well. And at $20 billion, now you're on 40 times earnings, and I definitely don't want to pay 40 times earnings if that's your long-term sort of peak of your long-term sort of more sustainable profit level. So, yeah, that's sort of how I think about those. Oh, and from an investment perspective, the other one mentioned group I didn't mention as well, which hasn't gone for a run yet. But if you're looking for a group that probably maybe 6 months or a year away from going for a run, is some of the consultants as well. Because at the moment, it's all the people sort of digging in and going, do I get involved in the infrastructure in terms of all these cloud computers? Do I get involved in the compute with all the NVIDIA and Google and AMD and those ones? Or do I get involved with the software providers at the end, which is effectively Google's your only choice, but maybe Microsoft a little bit, as an open AI play? Or do I live on the fact that actually in another year or two, everyone's going to want this AI solution. A whole bunch of people, all the good AI people are going to be with the bigger companies. And so there's going to be a bunch of people just paying consultants to say, come up with an AI strategy for me, Martin, and charge me lots of money for it because I really need to put it in my next annual report, And so, whether you're IBM or you're Cognizant or Accenture or someone like that who's just going to make all this money from people that just want to, I just need AI and put it in my annual report,
Well, I do expect quite a few of the large companies to start having a section on AI because they have to be seen to be doing it, right? Because everybody expects it. Of course, all the analysts will be asking them.
What's your AI strategy? Yeah. But some of that's for what I was being slightly facetious, but really for someone like yourself, that's the type of thing where, you stop running regressions, Martin, or start running correlations and stuff and start running a machine learning model, and all of a sudden you've doubled the fee you can charge for this stuff. The answer might still be exactly the same, but, it's not it's effectively a, it's an AI model that spat this stuff out, and now you can charge more. And if you're and that's probably some of the bit I worry about with some of the spend numbers that I look at, where I'm like, oh, okay, people spent X amount of dollars on AI last year, and this is what we're going to expect to spend the next year. Is a lot of that's going to be bullshit, where it's just going to be like, okay, you used to be an analyst, and now you're a data scientist and so now you count as an AI spend, And so it's really just, you're a statistician. You used to be a statistician, and now you're a machine learning specialist, or whatever the case is. There'll be a lot of that just sort of bullshit where people are like pretending they're spending. They're just changing people's titles and pretending that we're in AI.
Yeah, well, I actually saw a university in the US advertising a artificial intelligence course, right? And actually, it was an IT course. Rebranded, because they wanted to get on the wave and try and get all of those students to come and be parties to this AI thing. But it was just pretty bog standard, IT platform.
Yeah, absolutely. I mean, I've done courses 10 years ago that Python courses that sort of do artificial intelligence type stuff, and I'm absolutely positive those same ones will rebrand themselves as as artificial intelligence. Get in and it's all. Very doable as long as you can charge money for people. I'm sure that will happen. Yeah.
Well, you might be interested to know, I have been experimenting a little bit with GPT and the data from the DFA surveys. Right, it's early days yet. I haven't got any detailed conclusions yet, but it's an interesting thing because I did try 2 or 3 years ago on a major project with people who were actually looking at some of these network learning solutions to try and actually see whether we could run simulations based off my data and reach conclusions that were sensible. They couldn't. It was too complex. So it'll be interesting to see whether this next generation actually allows us to take it into a new realm. So it'll be interesting to experiment with that.
Yeah, but I think what you're hitting on there really though is that 5 years ago you can still run the stuff 5 years ago that you were doing. Like, I mean, I was doing language. At my last role, I was doing language analysis of annual reports and all that type of stuff to try and dig in and work out when do companies change the tone of their speech, and does that change a little bit earlier? It's this whole idea that when you've got a good story, it's really easy to tell. Hey, I doubled my profits last year, everything's fine. Whereas when you've got a bad story, it's always a little bit more complicated. Okay, so profits fell, but let me tell you why, Martin. I've got this story that I've got an excuse, and so. And so we're digging into that. But we had to know a fair bit about the whole process and how to do it and how to manually do it. The issue is what's really for me is what this is doing is this is allowing a lot of people without deep programming knowledge to actually access a lot of those same insights. And so, and that's the real benefit in some industries. The problem in finance is, and particularly share price stuff, is everything just gets so overfitted that it was like, if you buy stocks that start with the letter I on every second, third of the month, look how much money you're going to make. And you're like, that's not an investment strategy I want to, that's just you mapping back to data over the last 10 years and coming up with some weird, wonderful, correlation that is probably just spurious because it's overfitted. But the stuff that does work really well for is the whole, is this? I've got images of cats. Is this a cat or not a cat, or is this a flower or not a flower, whatever it is. That type of stuff AI is really good at. Which is there is a definite answer as to yes or no. And the other thing is, in terms of, I don't know, for anyone who hasn't used ChatGPT much, it is very good at programming. So in terms of helping you to program, it helps you. It makes people much more efficient. And the other one is all this marketing stuff and documentation and copywriting. That's the most obvious stuff. Where it's like, as you said, there's the legal stuff. It still needs work on. They definitely need to be able to go, okay, constrain your write me a legal document, but constrain your precedents to precedents that actually exist. Don't make them up. They do need to fix that part. But if you're writing a marketing document for explain why my company's so good, or I need to write a profile for someone to put on a website, I don't need to send that to an offsider anymore. I can send that to ChatGPT. It'll come back with 80% of it, and I go, that's what I would have expected to get from my copywriter anyway. Something that's 80% right that I can just fix, or write me a policy on why you prefer not to share all your clients' data with the world, whatever those, or you're doing RFPs for people explaining, rather than the 3 bullet points, turn this into 200 words about why we really, really love our clients. That type of sort of, the bullshit jobs, it's very effective at doing, where it doesn't need to be, the precision in marketing doesn't need to be as precise, I suppose, as opposed to the other constraints. And so
I like that. It's all about BS.
Yeah, that's right. I'm just sort of filling the gap. And so so it's a mixture of that stuff, and then the other one is obviously working the constraints. And so, but I guess the types of things about saying it's always been possible to run these simulations, say for let's say the more complicated ones where you do need an answer, like you're designing a bridge and you want to run a whole bunch of different simulations and whatever it is and test out designs, cheapness and whatever things. It's been possible for years to run this through machine learning and all that type of stuff. A lot of ChatGPT and these other ones aren't creating new things to do those, but what they are is they're making it a lot more accessible. And so rather than needing a programming specialist, you can now open it up to more people to be able to do that. And that's where I think the productivity gains come from. The same way that, I didn't need to be a typing specialist to be able to do stuff in the 60s. I just had my assistant who'd do it all for me. And then the PC came out and made everything a hell of a lot easier. Okay, I've got a backspace button I can use now, so I don't need to be whiting out and doing all that type of stuff. I'm much more efficient. I can do this myself. Yeah.
And I'll make the point, the old productivity conversation, because, of course, everybody argued that PCs would make people more productive and et cetera, and a whole lot of jobs disappeared. But actually, if you look at productivity measures, and, Australia's a good example, productivity hasn't improved. It's interesting that the RBA, in their announcement today, productivity at least a couple of times. And last week, of course, Phil Lowe said we need to improve productivity. There's no guarantee that productivity improvements will happen, but what you can guarantee is a whole bunch of jobs will disappear, which actually then may put more people out of work rather than in work. So there is a sort of a question as to whether this is actually a zero-sum game or something else. And this productivity conversation is actually then linked directly back to this question of inflation and interest rates, isn't it?
Absolutely. And that actually, so you hit on a few good things there. So let me start with the overall productivity, but we won't go too far from the RBA because I want to come back to that.
Yep.
Okay, so productivity-wise, you're right. If I can, if I have 10 people working for my firm, I can fire one of them and we produce the same amount of output without that one person. Okay, so productivity theoretically is improved for my firm, but that person can't get a job somewhere else. So as an economy, we're still producing the same amount. Yeah. That was where you're coming from?
That's exactly right. Exactly right. So you look at it at a microcosm level and you might be more productive. But if you look at it at a societal level, you've got more people who are now outside rather than inside, and effectively then required to be supported in some way or the other, and whether it's a UBI or whatever it is. So what you're doing is shifting the deck chairs, but not necessarily improving the boat.
Yeah, so it is very much about having a transition for other people into how can they get those people into jobs that are actually going to mean something and do something other than there's a couple of observations about that. 5 years ago, what we thought would happen would we lose a lot of blue collar jobs, and say driverless cars, more robotics, all this type of stuff, and you'd lose a lot of blue collar jobs from that, and a lot of less educated stuff. So far, and this first round actually doesn't look like that's going to be the case. Looks like driverless cars are a bit further away, but probably I think the AI stuff will bring them closer. But we're actually losing a lot of white collar ones, like the copywriters and the all these types of things. And I think as well, journalists love writing about this because it's a bit like that definition of recession and a depression. A recession is when your neighbor loses his job, and a depression is when you lose your own job. And I feel like that's a bit like how reporters are looking at this, because reporters keep wanting to write about it because it's like, well, it's one thing to say robotics might take away a bunch of manufacturers that might lose their jobs, but actually this is going to affect journalists. This is going to affect me, and so now I'm much more worried about it as a theme. So yes, so we do need, if we're going to get through this successfully without major political upheaval, then we do need places for people to go and things for them to do. And in particular, keep a really close eye on that whole driverless cars, because there are a lot of people involved in that sector that I think you would call Trump voters, for example, and I think they are susceptible to populists. I think you'd put that as a class of an amount of workers who are susceptible populists, let's put it that way. And so if you don't manage that properly and all those people lose their jobs, then you're going to get and don't get new ones, then you are going to have political upheaval and the chance for more populists to gain power. So absolutely an important factor. I'd keep a very close eye on driverless cars. At the moment, though, it is actually a lot of the white collar workers that are, your marketing assistants and your copywriters and, some of the junior lawyers and things like that I think are really at risk from this initial wave of AI stuff. I
have to remind you of Hitchhiker's Guide to the Galaxy, and in part of that, they actually discovered a planet, right, where they actually shipped out all the marketeers and hairdressers and all the other hangers-on.
Telephone sanitizers.
Exactly right. I just keep... That's such a good book.
It is. Yes. So I doubt that will be a solution. Is put them on a boat or a spaceship and send them off. I think it will be the problem will be, you need to find things for people to do. And
just ask Elon. Here's a.
Yeah, that's right. And I think, look, I don't know. Well, let's not dig too deeply into this because you spend a whole episode on it. But I guess my big picture thoughts are, I love the idea of having universal basic incomes of some sort, but I much prefer the idea of actually giving people jobs because I think if you were to tell a large portion of the population, well, actually, you know what, society doesn't really need you, but here's some money, go and keep yourself entertained. I think that's going to create a massive drug problem and depression and political problems. Whereas I think if you went, here is more jobs, maybe the government funded in some way, here's more research jobs or whatever it is, however I think that would be a much better solution. But I do think we're going to try the other way first. And then, anyway.
Well, because the point is that the other way first is closer to the current political norms, right? So it will be easier to sort of move in that direction rather than something more radical.
Let the rich get richer and...
Yeah. Yep. Yeah, it tends to be the way things go. Well, come back to the RBA, right? Because the RBA has been banging on about productivity over the last couple of weeks, right?
Now, David Llewellyn-Smith, you've had on here a few times. So he's our strategist. Now he's convinced that, and I think he's probably right, that what the RBA is sort of saying is, and he's saying the messaging's really mixed, but he's basically saying this is the way the RBA is saying, hey, maybe we shouldn't run record rates of immigration which is pushing up housing prices and energy prices and all these other things, when we can't stop that by raising interest rates. Like you can't stop if you keep jamming as many people as you possibly can into Australia and expecting house prices to fall, it's not going to happen until you actually have a major accident. You've got to keep jacking interest rates. And I think that's what they're effectively saying in this productivity part. I don't think the government's going to get that message. I think that's way too subtle for them. And so, so that sort of leaves you with an accident, basically. So basically saying, if you flood the market with extra people, particularly students who are going to work for minimum wages or close to minimum wages, and they're going to keep wages low because companies will be if they've got a choice between hiring a recent graduate or two or three recent graduates for the same price as somebody with a few years experience, maybe they go down that route. So we haven't got particularly high wage growth. The flood of immigrants is going to keep wage growth low. The RBA is complaining about productivity because of that flood. I think that just sort of ends up in that same position where we're looking at they're going to hike rates until they break something.
And the point there is that the rate rise which came through today, right, completely expected in my view. It's interesting, quite a few of the bank economists were actually backing off from it. So again, CBA, who's tended to be more dovish on this, has consistently wrongly forecast what the RBA is going to do. And some of them are now saying 4.5, 4.6. I think Deutsche Bank is now 4.6. Rates are going to go higher.
Well, the commentary seemed to say that today. I mean, they seemed to foreshadow that basically, we're going to stick rates up again. And so I guess my take is it isn't high. Like I don't know what they're talking about from wage growth. Worried about a wage breakout that's happened elsewhere, but it hasn't happened here. And we're running record rates of immigration, which is going to keep wage growth down. I mean, we want wage growth in the 3 to 4% range. That's where, we want inflation of 2 to 3% and wage growth of 3 to 4%. We've actually got wage growth in the sweet spot. So yeah, and I think there's, I think they're jumping at shadows on that, but they're going to keep going. It does look like they're going to keep going. And to me, that just means they're going to go until they break something, or the US breaks something first and break something big enough.
Yeah, and I think that point about the US is quite significant, right? Because there is clear evidence that the Federal Reserve is going to continue to go higher. And it's interesting that a few of the Fed people have rolled out quite recently before the the meeting ahead, talking about we haven't done the job yet, we've got more to do. And of course, the UK is moving rates higher. New Zealand is leading the charge.
That's right. And a lot of this is about employment.
Yes.
Yep.
Yes.
And a lot of this is about employment has surprised on the upside. Now, the problem is, though, bankruptcies are also surprising. That's not a surprise on the upside. And credit continues to pull back in most economies, and particularly the US. So the danger, look, employment growth is usually the last one. Unemployment in particular is usually the last thing to come in these cycles. And so what the danger is that by the time you actually see it in the employment data, and they go, oh, we've gone too far. Now we need to pause for a little bit or cut rates. It's already too late. Like it's already the cycle of bankruptcy has already started. And we speak about these long and variable lags. They go, oh, okay, now it's time. You've done too much. Now it's time to start cutting rates. Now you're 12 months or 18 months away from that actually having an effect on the real economy. There's a So I think that we're just more likely to run into problems. I think the way things are going, it does look as if employment's in Australia it's not particularly strong. Like it's certainly been strong in the US, but coming off. Whereas the employment, the Aussie data to me, I don't know. I don't know how you see it, Martin, but from my perspective, I look at it and go, yeah, that's roughly what we wanted to get to, and they're complaining about it. They're saying no, that's way too high, and you're like, well, it's well below inflation. It's real incomes are going backwards, and yet you're saying it's way too high. So,
well, my own view is that this wages thing is completely out of cycle. Oh, hang on, have you disappeared? No, can you hear me?
I can hear you. Yep.
Yeah. Okay. Sorry, we had a little bit of a glitch. The mileage between UK and Oz just extended slightly or something. So the point is this, that the wages story, is that in real terms, most households have gone backwards over the last 10 years. And those on lower wages and those who are younger have done significantly worse than those later on in their life. So there is a fundamental structural issue in terms of the way that wages are working in Australia. And I know that the Fair Work Commission
makes that whole thing worse.
Yeah. So everything they're doing is making it go the wrong way, isn't it?
Oh. Yeah. Yep. So interest rates up. That benefits older people and punishes younger people by the same. Yeah. Exactly the same thing. So, we're forcing all the adjustment upon one group of people who probably least deserve it, and but that's the traditional way we do it, and it doesn't look like anything's going to change.
No, and it's interesting because the Senate estimates. There were a number of people asking Phil Lowe about this, and he came back to his famous argument. It's still this, inflation's too high, it needs to come down. The lever I've got is interest rates, so therefore that's what we're going to do. And there were various people in the Senate trying to actually get him to argue it differently, including Nick McKim, who was saying, Mr. Lowe, there's a hole in your bucket, right, with regard to rents, because it's a circular argument, right? Rents go up, making inflation higher. Interest rates make rents go up. Therefore, the more you put interest rates up, the more you're putting inflation up. He didn't want to
exactly, and that's argument. The point about that's why I'm saying. Well, that's what David's saying is what he's making with this productivity argument is really a population argument, because he's talking about saying, if you don't build more public transport and more energy and more houses, then all that happens is and your energy prices go up, your transport costs go up, your houses prices go up, and they can't stop that with houses and all the energy infrastructure and road infrastructure and train infrastructure and all that type of stuff, on a dime. And so the fact you've decided to run a population where you bring in record amounts of people, and it's not inflation that can be fixed by raising interest rates. It's a supply problem once again. We have a supply problem that we don't have enough houses or enough houses that people can live in, I suppose, because of all the empty ones, and you don't have enough energy infrastructure and all those other things. So jam-packing more people in and raising interest rates doesn't fix the problem. Something, and then you force demand down to the level where people start moving in with each other, and you end up solving the problem that way.
Well, he did actually specifically in the Senate estimates make the point that people need to, live in together and share the accommodation. That was one of his arguments. Interestingly, though, on the question of supply and demand, there's more than 1 million homes vacant according to the census data. And that was a couple of years ago, of course, now. And that includes Airbnb, of course, which are short-term lets rather than long-term lets, and people who actually hold property without using it and just basically holding it deliberately vacant because of the capital appreciation, as well as those with holiday homes and those sorts of things. So I think there's a much more complicated set of arguments on the supply side than just build more cheap high-rise accommodation to try and actually solve the migration problem. And by the way, I'm also of the view that the migration numbers are way, way too high. What's it doing is putting more downward pressure on wages, because it's quite clear that some of those people coming into the country are prepared to do jobs at a lower price point, as it were. Building more stuff to try and actually provide enough accommodation at a time when, of course, building approvals have dropped to one of the lowest I've ever seen. So this is a massive, massive situation that we've created. And yet we're still seeing interest rates continuing to rise. So I don't think that necessarily the levers that are being pulled will actually get us to where we want to get to.
Unless we break something. So I guess what I'm saying is if we end up with a big bankruptcy cycle and lots of people out of work, then that fixes our problem, doesn't it, Martin? Because all of a sudden now inflation pressures go away, people still have to start moving in with each other and jamming, 4 to a room and all this stuff like that, which clears up our rental thing because nobody can afford it. And so it's effectively what we're the path we're on is we know what we're doing, jamming more people in and raising interest rates isn't fixing the problem, that's making it worse, unless we can do enough of that interest rate rises to physically break something and cause demand, a big demand shock.
Yeah, so what you're talking about then is we need a recession. That's actually the conclusion. You can't solve this without a recession.
Yes, that's right. That's right. And sorry. Let me clear that up. You can't solve it the way we're doing it currently without a recession.
Yes.
Yeah.
Yes.
There's other ways you could do it. You could lower inflation. You could put higher fees, people with more houses, and there's a whole bunch of things you could do to try and solve it. There are lots of other policy things which I won't go into. We're not doing any of those. We're repeating the same things and hoping that something will be different. And what I'm saying is the only way by moment is causing an accident of a recession, and more people will sell their second house or not have a second house. More people will move in together, all that type of stuff, and then that will solve our problems. And
and so the point
doesn't seem ideal, but that's what we're trying.
Well, it's the only formulation that the RBA and the Treasury and the other mandarins are actually wedded to. And of course, it's the same in the US, same in the UK. New Zealand has explicitly said they are going to go through a recession. It's going to be hopefully a shallow one, to try and actually get the supply and demand issues actually optimized. But I just worry about the social consequences of this. I can understand the economics of it, but the social consequences and the waste of people and time and resources that's being created on the back of this. And the unemployment number, by the way, is a bit artificially low because of the way that it's calculated. So I think that the Roy Morgan employment numbers is probably a better indication of what's going on. And they've been tracking a rise recently. And by the way, Roy Morgan also reported consumer confidence continue to drop. So they're going to actually have less retail activity, less purchasing power, all of those things. It's going to be a long, slow grind. How does that change your investment strategy then, Damien?
Yeah, so there's two markets really, two big markets. You've got the bond market and you've got the stock market. So the bond market is saying things are going to get bad. There's probably going to be a recession. inverted yield curves even in Australia. They've been inverted in the US for a while. Rate cuts sort of baked in, and late this year we're going to be cutting rates, and we're going to be in a recession, is what the bond market's saying. Stock market's sort of saying the opposite. You look at, say, quarterly earnings, and Q1 was sort of negative 3 or 4%. Q2's forecast to be about negative 8 over the recent months. It's sort of been getting worse. Q3 has been sort of getting worse. It's down to about 0. So 6 months ago they're expecting 10% growth. Now it's 0. By Q4, stock market thinks we're going to be doing 9%. So it'll all be fixed by Q4, in theory. So I think the stock market's got it wrong. I think it's got it wrong in terms of their earnings.
And just on that,
and you take 10%.
Damien, just on that, you're breaking up a little bit, but just on your point there, the stock markets have got it wrong, right? They're still thinking rates are coming down later in the year. It's true here in Australia even now. It's true in the US. The markets have been wrong on this for best part of a year now.
Yeah, I guess it's a question of, I guess this is a question about recession. When do we hit the recession point? Because at that point, rates need to come down. But I guess what I'm saying is, if rates are coming down, company earnings are going broke, and we're having demand problems. So, company earnings will not be rising by 10% in that environment. They could be falling by 10%. Best case, you're 0 in terms of that. Oh, sorry, analysts are crazy in terms of those numbers. It's and they've got the same forecast for next year. They've got another 10% going into next year. So I think that's I think that and then take one step further back again. Like, if we look at pricing of the markets, so you go, okay, well, so what earnings is that based on? So if I took the global market excluding financials and resources, because they're a bit weird in the way they report. It's much easier. I think you get a much better feel if you look at the markets without those. So basically, we're trading on just under 20 times earnings. The average is closer to 16 for the last sort of 20 odd years. You've basically only been higher in history twice, once during the tech boom and once during the post-pandemic, that sort of growth boom we had. Now, if earnings are wrong by 10%, so if that number I'm looking at is 10% too high because analysts have got factored in 10% growth that just ain't there, then all of a sudden we're back to sort of pretty much all-time highs. You go from almost 20 times to sort of 22 times or 23 times earnings. That's pretty close to all-time highs for how expensive the market is. Now, you usually only get all-time highs when you're getting this great profit growth. You ain't going to have all-time highs and with profits falling by 10%. So the danger is earnings fall by 10%. Markets then say, actually, maybe we don't want to be paying record times for falling earnings. Maybe we'd like to be paying average or below average. And so that's where you get 20% downside, 30% downside to markets if you in a big accident. In an average accident, so the base case is you've probably got 15 to 20%. 10% of that's from earnings, or 5 to 10% from earnings, 5 to 10% from multiples coming back. But if they let it get out of control, and you do get a much bigger earnings down cycle, then you're going to get a much bigger price fall as well. And so that's where you can come up with some pretty dire scenarios.
Yeah, and as we've said, of course, it's always zigging and zagging and thinking about what happens if. What happens if there's a policy mistake? What happens if, in fact, markets fall? And I've had the view for some time that markets are still overvalued, looking at the forward projections of income, even allowing for AI, which makes it a pretty precarious time to be in the markets and trying to make the decisions given the level of uncertainty, which I think is as high as I've probably ever seen it, frankly.
Yes, yeah, absolutely. I think there's, yeah, I mean, look, sorry, yeah, important insight is, there's times when you can be pretty certain about what's going to happen. There's times when you need to realize there's a broad range of outcomes, and diversify and keep a be more diversified in those times, and keep a broad mind, keep an open mind, and also have apologies. A big thing is having these ideas about upsides and downsides, about where's my upside case, what happens if everything goes right, where does that go, and what happens if everything goes wrong, and there's times where you look at markets, and now is one of those times where you go, okay, I paint the picture and I get everything going right, and there's maybe there's 5 or 10% more upside I can get out of this. And you paint everything going wrong, and you're like, okay, now I can see 50% downside. Okay, so how do I position my investments within that environment to make sure that, how do I get the upside, or at least some of the upside if things go right, and how do I make sure though that it's more about protecting myself on the downside at this point. Whereas at other points in the cycle, it'll be the opposite way, where you're looking to go, okay, if everything goes wrong, there's 5 or 10% more downside, but if everything goes right, there's 100% upside. And so that's where you in those cases your investment, you want to skew in one direction. But for me, very much at the moment, it's about skewing your investments towards the more conservative points.
Absolutely, because of course the downside risk is probably significantly worse than the upside potential, and that's where you tweak it over time.
Yes.
And it's worth saying, of course, that what the World Funds and Nucleus Wealth, that's what you specialise in, trying to work out some of these things and trying to actually position for some of these alternatives in this very complex environment.
Yeah, absolutely. And that's it's a sad message we peddle for the last little bit. It's there's a thing out there that brokers and are always positive and always always talk about the market going up. Part of the reason why is if you turn up to an investment person like myself and you say, what do you think? And we're like, actually, we're a little bit worried about the market. We're being quite conservative. A lot of people go, well, I'll sit on the sideline. And then, whereas if I told everyone, when's the best time to give me money? The best time's always now. That's sort of the stockbroker point of view. The cautionary tale I'd say about that though is that you want to make sure that you do have some exposure at points and working out where you are, because what we do find sometimes is we'll have people who are so conservative that they sort of say, oh, well, we'll sit out of the market completely. And then when we do actually jump in and switch to something quite positive, it might take them a month or two to come along and decide, oh, actually, yeah, we'll jump in. And often you miss a lot of that upside. So, I guess what I'm saying is you should make sure you have some exposure and make sure you do have some, focus on where you're going to get some upside if things don't go exactly the way expected. But keeping that, leaning into the cycles. You're not you're not making bets that you're going, I'm going to be exactly right on when to call every single point of this cycle. It's about saying, no, I'm going to lean into it when the odds are more towards conservatism. That's where I'm going to lean, and when the odds are more towards aggressiveness and taking some risks, I'll lean that other way. But it's not about an absolutism. It's not about saying going to be 100% equities and then going to be 100% cash and then 100% equities and then 100% cash. It's too easy to get caught out and lose out on those ones.
Absolutely. Well, the whole question of asset allocation and through the cycle is a very important part of what you guys do. Well, Damien, I want to say thank you very much for your thoughts today. I really appreciated it, and for all the comments in the chat and everything as well. We just have a couple of minor freezes, but I think we got through that pretty well. And I look forward to doing it once again in about a month's time, when we'll sort of sequence these conversations around the RBA meeting. So we'll look forward to the end of July, when they probably will lift again.
Their commentary today certainly suggested that they will.
Correct. Well, thank you very much. I'm going to take you offline now. Well, when I say that, I'm going to actually not take you offline, but you might want to mute yourself. And just to say to everybody, thanks very much for watching the show today. And check out the recorded shows over the next few days. I hopefully will be back next week with a show that's specifically going to be looking at the detail on our mortgage stress analysis, which I published at a high level. But there's a little bit of uncertainty because I'm waiting for my stuff to arrive, and I'll get a date, which could be Monday or Tuesday of next week, in which case I might not appear for a live show, but I will continue to make the other shows in the meantime. But I will be back, and so check out the blog for updates and for the program ahead. So this is Martin North from Digital Finance Analytics saying thanks very much for listening and watching, and we'll see you next time. Take care.